Consumer sentiment, University of Michigan number, 64.9, revised slightly higher from the first reading of 64.6. The market is liking this double dose of good data this morning with the inflation data this morning. Look, maybe the Fed can pull off the soft landing. Let's get back to that issue, and Jay Hatfield is here with us on set. Jay, good to see you.
Lauren, thanks for having me on. It's great.
The market, we have a rally. We have a little bit of a rally right now. Has the bottom been found?
Mm-hmm. That's been our view. We've been way more bullish than most strategists. Our target for year end is 4,500 on the S&P, and I think that's probably in the top decile. And the reason for that is that we're far more bullish than most about inflation. We think it's actually negative right now, that we have a deflation going on.
Really?
And so the Fed should pause right away.
Well, what are you looking at that makes you say that?
We're looking at the housing sector.
Okay.
That's really the key driver of all cycles, both for recession and also deflation. It's 41.7% of core. And the problem is that the Commerce Department is reporting that as a 9.6% annualized rate, when we all can look at Case-Shiller, and it's declining pretty rapidly. So there's roughly a 12-month lag of CPI to what's really going on. In fact, we have an index you can get on our website that is real-time inflation, CPI-R, and that's been negative for the last quarter.
Do you think, A, we will see a recession, and B, if so, when? And I ask because Deutsche Bank is saying, well, now a lot of people were agreeing for the most part that there'd be a rally in the back, a recovery in the back half of the year. But Deutsche is now saying, no, you get recession in the back half of the year.
Yeah, we're actually the reverse. So the first quarter normally prints negative just because of statistical aberrations. They can't really measure the first quarter because there's a big decline from the Christmas quarter.
Right.
So you could get a negative print. That could be bad for the stock market because people kind of overreact to that. But we think the economy is resilient for really the same reason, in that we have a shortage of homes. It's the all-time low, and there's an estimate it's about 2 million unit shortage. So the normal cycle is not going to happen. We have mass layoffs in autos and housing, and then you have less consumer spending because you have unemployment. So that's our thesis of why it'll be resilient, whether we have a technical recession or just roughly slow growth is, yet to be seen.
Okay. Jay, thank you.
Great.